Hello, I'm Jannarone, Editor-in-Chief of CorpGov. Very happy to be here with another friend from Vinson Elkins. We have Jon Solorzano, who is an ESG specialist, and we're going to dig into this. Jon actually just penned a really interesting article, and the lead is ESG is over as we know it. So, Jon, I want to dig into a lot of specifics. Sure. I've been following this for a long time. What we saw, as I was just discussing with you in the green room here, 5 years ago, ESG was just bubbling up and then it exploded. So tell me, where are we now? I feel like the dust is settling in a way.
Yeah. I think, over the last couple of years, we started seeing a lot of corporates make commitments around ESG because they were starting to see the pressure from their institutional investors, BlackRocks, Vanguards, and others were starting to demand things of these corporate issuers. I think in the last year or so, that has kind of subsided a little bit. You still see a fair number of shareholder proposals. They didn't get a lot of support, and there's a number of reasons that went into that. But I think, as the political environment shifts with an election year, I wouldn't be surprised if we don't see a little bit more action in 25, 26 once things normalize. I think a lot of companies were starting to make these commitments because of that pressure, and then they started pulling back because they were also starting to see, they were seeing the news, the articles that, ESG is dead, or the anti-ESG movement was really pushing people to sort of maybe say, let's take a beat. I think you also have the overarching regulatory environment where the SEC signaled that they would be having a climate rule that still has not come down yet. We're now anticipating April of 24. So I think there's a bit of a wait and see approach that's going to happen. So it's going to be an interesting ride this year and in future years as well.
So Jon, I want to ask you, not to make this too controversial, but it is a controversial topic, I guess.
Sure.
At our conference, which a couple of your colleagues attended,
Sure.
3 of them, we had a fun panel with an ESG specialist from Goldman Sachs, and then we also had Omid Malik there, who is anti-ESG. What do you make of these anti-ESG guys? I mean, they are vocal and
Sure.
aggressive. They even hate DEI.
Yeah, no. Listen, I think that they're probably coming from a very reasonable place in some respects. They are pushing for what they believe is you should only be looking out for the interests of shareholders.
Right.
And some of these initiatives are, dilutive to shareholder value is
right.
how they're positioning it. So, you're not necessarily promoting the most meritorious people with your DEI initiatives, or pulling back to sort of meet some climate ambitions or whatever is actually going to be harmful for shareholder return. That's their perspective. Now, the counterbalance to that is what you would see from the large institutional investors who are not, actively managed funds.
Yeah.
And they're saying, we are in this stock for the next 30, 40 years. It needs to have value in 30 or 40 years. And so we believe the climate science, we believe that diversity, equity, inclusion is good for shareholder return because it leads to better outcomes at companies. So that's where you're seeing this tension. And so I don't necessarily think that the anti-ESG people are wrong-headed or right-headed. They're just viewing, I think, the time horizon slightly differently. And so I think that that's kind of where some of the tension is coming.
That's a smart way to look at it. I interviewed Marty Lipton a few years ago. In fact, he was at that conference right when ESG was becoming a big thing. Sure. And he'd written this article called The New Paradigm. And what he said was the purpose of a corporation is not just to serve shareholders, but all stakeholders,
Yep.
which, I kind of agree with that, right? He said the corporation is a privilege to have that. And, our nation state, lets you do this, but it's not just about shareholder primacy.
Yeah.
And he actually said shareholder primacy is BS.
Yeah.
He said Milton Friedman came up with this and it was bonkers.
Yeah.
So I guess there's got to be some middle ground
Sure.
here, right? I mean, I don't want to say screw all the employees and business partners and it's all about the shareholders. If you do that, it's just 1980s greed, right?
Right.
So how do we sort through this?
Sure. Yeah. So I think that what Marty Lipton was saying is probably similar to what the Business Roundtable also signed on to. I think it was in 2019, where basically you had CEOs basically at most major companies in the U.S. say stakeholder primacy is what we should be pursuing. I think that that's actually largely consistent with Delaware fiduciary duties. And there's a little bit of a nuanced point there, which is you can do all of those things and still be pursuing shareholder value at the end of the day.
Right.
And I think that, at least as my clients, shareholder primacy is still first and foremost. I think that stakeholder primacy is not something you should be pursuing. You should be pursuing shareholder primacy but being very mindful of your stakeholders, because if you're not treating your employees well, or if you're not cognizant of how your consumers are reacting to your products, they're going to boycott you. That's bad for business. You might want to think about those risks. You might want to be planning ahead of those risks. You might want to be making sure that management is properly sort of thinking through the enterprise risk management process for those types of things, because you can call that stakeholder primacy or you can call that smart business. And I think it's smart business. And at the end of the day, I would probably posit that most shareholders would want every company to be pursuing smart business.
Well, yeah, I mean, look, so just a bit of a personal example. I'm frustrated with my apartment building because they had taken away the doorman, and it sounds obnoxious, but there used to be these amenities that I was paying for, and I'm hearing people who moved from New York down to Florida, they're saying like, this is ridiculous. I'm paying New York rent and all this is going away. What I'm thinking to myself is, and Cushman and Wakefield has this huge ESG thing right in their about section, and I'm thinking, ultimately, if you frustrate the people who pay you in the name of the bottom line, like that doesn't work forever, right? You're going to lose customers, right?
Yeah, absolutely, and that's the tension. I think that if I'm a big sort of free market proponent, I think that the market will sort itself out. There are definitely some externalities that need to be addressed. However, I think that smart businesses will realize treating your employees better is going to lead to better outcomes. Now, what that time horizon looks like, I think, is up for debate, because it's possible that you're going to have to invest and you're going to see some maybe ugly SG&A for a period of time.
Yeah.
Over time, maybe that's the right investment, and that's where there's a little bit of a challenge, where I think some shareholders are going to be holding you accountable on different sort of perspectives on what you should be doing now. And I think that is really acute when you're talking about kind of these difficult operating environments where it's not like low interest and you can just kind of make all the investments that you want, this sort of, I think it becomes a little bit more acute when you're in a very difficult operating environment to be making these long-term investments and not delivering shareholder value on a quarterly or an annual basis.
Now, John, just shifting gears a bit here, you were telling me that you are seeing, as we enter proxy season here, a fair number of potential ESG-based shareholder proposals, right? So it's not going away.
It's not going away. I think there's a lot of reasons that you saw shareholder proposals rise in the last couple of years. 2021 was the high watermark of the actual approval or support of those. Last year there were a ton of them, not a lot of support. I think we're starting to see shareholders make slightly more reasonable asks. Maybe, at least I've seen a number of large shareholders who are actually getting a little bit more active, which is, they're targeting a number of my clients who are in the energy space, and so on, climate change specific issues, and I think that they're being a little bit more tailored around it. The other thing that I would say is a lot of companies have sort of done better in the last couple of years, so there's a lot less low-hanging fruit to be targeting. So I think the proposals that you're seeing are maybe a little bit more surgical, because they're now focused on the companies that actually have outages that they've identified. That being said, I still think that the support rates are going to be relatively low. I think the large institutional investors have a lot of pressure, politically and otherwise, to not be out in front of their skis on a lot of things, whether it's DEI or various E issues. But I think it's going to start trending back towards you're going to start seeing some support for these things. I don't know if it's ultimately going to change a lot. The other one macro trend that I would just note is you are seeing regulators really digging in here. And so you can say, well, shareholder primacy and shareholders are not really pushing on this stuff. Well, regulators are, and companies need to be cognizant of the regulatory environment, whether that's, on greenwashing. A lot of companies have been recently getting in a lot of trouble about saying things that aren't really supported by the science or they're not really backed up. And you're seeing people like California or states like California who are now instituting new regulations that every company is now going to be required to comply with. So.
Well, I want to ask you something that's crossed my mind a lot, and here we are in the free state of Florida. Ron DeSantis, he makes ESG. I mean, it's almost like he's stirring people up. It's almost like he's, I feel like he's incensing hatred or something. I feel like it's almost dangerous.
Yeah, I mean, I don't know that I want to wade too deeply into the politics of this, but I certainly think that it is. perceived as a winning political argument to sort of say, well, these are just woke corporations who are virtue signaling or whatever, and they're not actually pursuing what they should be pursuing, which is supporting the bottom line for the business. And you've seen some really sort of nasty outcomes as a result of this. Target got slammed for their campaign. Bud Light. There's a whole lot of reasons why it can be really risky for businesses to be wading into these culture wars.
Right.
But at the same time, I think part of that is companies are wading into things because they are somewhat virtue signaling, and they're not doing it because there's a deep sort of commitment to it. Because if there's a deep commitment to an issue, you're willing to take the flack because it's right for your stakeholders. So I think that's something that companies need to be really thoughtful about, is like, who is the universe of our stakeholders? What we do shouldn't just be trying to pander to the left and the right and whatever. It should be really core to who our operations care about. And we're going to piss some people off along the way, and that's okay, and that's good for shareholder value. And I think a lot of companies go astray where they try to be everything to everyone, and so you just need to be true to who you are. And if that is kind of woke, that's who your business has decided to be, and you might be willing to receive some flack from it. So
yeah, I mean, I guess I'm a free market guy too, right? So I mean, if some people like that stuff, then they should have that choice, I suppose. One thing I want to ask, and I think that the answer to this should be pretty simple.
Yeah.
The E and the S can be controversial, but governance shouldn't be controversial, should it? Isn't good governance kind of a win for everybody?
I would think so. And when I run the ESG Taskforce for B&E, and I think of G as the glue for the E and the S, and so good governance is really what you should be leading with in all respects. I think that sort of chasing, I like to call them shiny objects, is a really bad idea for a company. You need to have good governance processes in place to decide, when are we going to pursue something, when are we not, how are we managing our risks. Good governance, whether that's structuring your board in appropriate manners, making sure that the management team is actually communicating with the board, and then that information is actually getting flowed down to the operators within the organization. That's all governance in my mind, and I don't think that should be controversial. And this, I think, goes to the broader point of ESG has become sort of a dirty three-letter acronym, and people are kind of lumping in the G with the E and the S, and I really think maybe you just call it good governance, or maybe you call it responsible business, and with kind of a governance flair to it. But whatever you want to call it, I think it's important to make sure that you're structuring your organization properly.
Well, that's a succinct way to put it. I like that, John. All right, well, this has been Jon Solorzano from Vinson Elkins. Terrific interview here from the ICR Conference in Orlando, Florida. John, thanks for joining us.
Of course. Thank you.